Good afternoon, everybody. Welcome to the Trader Merlin Show for your final show of the week. As you guys know, I will be gone Thursday, Friday. I will be back on Monday, so we're just going to take the next 2 days off. Well, not off. I'll be traveling to Texas and doing some teaching out there, so excited for that, but bummed out we'll be missing you guys. It will be bittersweet not having a couple of shows. Now, today, obviously, we're going to talk about, maybe a little bit later on, about NVIDIA's earnings and how NVIDIA is just driving this, and thank goodness I was wrong. I remember I was pessimistic on NVIDIA's earnings. I thought they were going to talk about a little bit of a slowdown here because of what happened with TSM. Lo and behold, phenomenal numbers and saving my hide on a couple of my positions. So thank you, Jensen Huang and NVIDIA. We'll talk about that a little bit later on as we progress through today's show. But I want to get to the star of the show. We have him on. We used to have him on every couple of months, and now it feels like it's on once a quarter, and now we're getting once every half a year. Well, we are going to talk a little bit more about bonds, equities, commodities, and currencies with my guest today. Joining me from the great state of Texas, we've got Mr. Scott McCormick on the program and talk about the B.E.C.C report. Scott, how you doing, my friend?
Good afternoon, sir. How are you?
Fantastic. I am glad to have you with us today. I know.
Always a pleasure.
I won't get to see you in person anytime soon. We're just talking about that, but sometime soon, maybe we'll even get you to have a visit out here to my studio, and you can do the show live with me.
That'd be sweet.
That would be sweet, right?
Yeah.
What's new in your world? I know you've got tons of stuff rolling out. We'll talk about your hedge fund class later on, which I think is extremely interesting, and the stock class and all kinds of other stuff. But what's new in your world? What can you share with our viewers?
You pretty much just mentioned it. So so back in March, roughly, fellow instructor Scott Mariggiulio, also fellow CMT, tapped me on the shoulder and he's like, "Hey man, what do you think about this? What do you think about starting a hedge fund class?" I was like, "Sounds great," And he's been working really hard on developing the content and getting things set up. But I think it's a really exciting move forward in the direction of the company and Trading Academy in particular, because it's really going to open up the door for those that want to kind of have more of a professional career in that aspect of the business. Possibly even set up their own registered investment advisories or their own hedge funds, their own family shops. So it's going to be a pretty interesting couple of years. And I say a couple of years because anytime you really get started in investment management, it can take you a couple of years to really kind of just develop a solid track record. I mean, obviously, when you're looking at investment management, for instance, if anyone were to go out and look at a mutual fund, and somebody handed you a prospectus on a mutual fund, and you look at the returns, you're like, "You only been around for 12 months?" We're like, yeah, but we've done really well. So they like to see generally a couple of years worth of returns before you can begin to really kind of solicit more data. But the types of programs and systems that we're going to be collectively working on, and I say collectively because this is more than just a class, right? It's more than just going in and learning about what hedge funds are and the systems that they use and how you can use them for yourself. We're going to get to the point to where students are actually developing new trading methodologies and systems, testing those, and then deploying those in a real funded account, right? And I say real funded account. I mean, we are going to have a hedge fund that students are managing. Scott's vision was similar to that of a lot of universities here in the U.S. that have graduate level programs, PhD, masters that are in economics and finance, and many of those students will go on to manage the university's funds. I'm not sure. I doubt that it's like their entire endowment fund, obviously.
Right.
But
yeah.
They've set up funds for these students to manage, so that they get that real world application before going off into the professional environment. So because it really there's a difference between theory and practice.
Yeah.
I think a lot of us know that, and so it's really going to combine the two in that class. And I'm really excited about it. So he asked me to basically be the assistant portfolio manager. And, we're just going to be the adults in the room to make sure that everything is going in the right direction and nobody's doing anything crazy and trying to be a lone wolf or rogue trader or anything like that. So yeah, it's going to be exciting.
Let me clarify for some people here real quick, because people are like, what is he talking about? Trading Academy is rolling out a new hedge fund class. So it's basically like how to start, build, run, manage a hedge fund. And what Scott was mentioning, which I think is a very unique piece, is the students in that class will actually be let me clarify, because I'm not 100% sure on the details. Will the students actually be trading real money in that hedge fund, or will you guys be making the trades and analyzing with the students?
They are. We're going to review their systems, but and a lot of the execution is going to be done through APIs.
Okay.
So Scott, and APIs are really just kind of like a bridge. So if a student wanted to, for instance, follow the systems in their own accounts, they're permitted to do that. However, when it comes to the fund, the fund is most likely going to have algorithms that will handle the execution. It was funny. So we were just in Scottsdale this weekend, kind of rolling it out for the first time and introducing students there. And Scott made it a point that he wants to beat Renaissance Technologies. That's his goal. I want to beat Jim Simons, which I think is a really good focus point there. Because when it comes down to it, it's like we have an incredible system in teaching students core strategy, right? But it's this approach is going to integrate a lot of different methods. Okay, so for instance, instead of just trading one style, these systems that we put together, we can automatically trade all four, right? Because you always run into a scalability issue when you're trading. There's only so many things that you can do. There's only so many stocks and currencies and futures markets that you can actually trade simultaneously. So building those computerized systems to help handle and manage that order flow is going to be pretty important. So it's really exciting. I can't imagine what things are actually going to look like in the next 5 years, to be honest, because if things go really well, we build up that track record, it's going to really kind of allow us to scale and implement more groups simultaneously. Because like when he had described it to me, my immediate thought was turtle traders, right? Which it's very different in that the turtle traders were given capital. They had to follow the rules. Here we're not necessarily for lack of a better term, pitting students against one another to see who the better trader is. That's not what we're doing. They're working collectively as a team. We're using primarily quantitative systems. We're going to be using 4 or 5 different methodologies that are pretty common in the hedge fund industry to begin with. And then from there, working on systems together, and as I just mentioned, kind of deploying those through various algorithms. But in the future, just having more teams, because for now, we're just going to be able to have the one,
right?
Just as we're rolling this out. But I wouldn't be surprised to see eventually, let's say in the next 5 years, to where we had a team in New York, we had a team in Dallas, we have a team down in Miami, we have another team in Chicago, we have another team in, let's say, Scottsdale, we have another team in Irvine. So there's a lot of possibilities here, so I'm really excited about it.
Yeah, very excited. Question from Lori says, what's API? That's Application Program Interface. And just so you know, as an example, Click would be a platform that doesn't have its own execution system, right? So it would use an API and plug into somebody like a Tasty Trade or a TradeStation or Schwab. It's an interface that plugs into somebody else who has all the data and access to the marketplace. So the assumption that I'm making is that this hedge fund program, they're working with a specific system, specific tools, and connecting to a different brokerage firm. So that's what the API stands for.
Yeah. They're setting up the fund with Interactive Brokers.
Okay.
And they're going to be using their systems for execution.
Yeah, with this, and I'm sure a lot of people are like, well, why would I want to do a hedge fund, et cetera? I mean, it is a lot of responsibility, and I think there's opportunity there, but there's a lot of extra steps that you'd have to take over being an individual investor, right? If you're just a typical trader by yourself, there's things that you can and cannot do. You're limited to some of the market data, market access, and just capital markets. if you're a hedge fund, there's a lot more responsibilities, and part of the class is going to be going through what are those rules, what sort of things you have to follow, what sorts of regulatory issues you're going to have to encounter, and how do you deal with all that type of stuff. So there's a lot of pros and maybe some cons to having a hedge fund, but if it's something that someone's interested in, why not learn to do it the right way under the guidance of Scott and Scott?
Yeah, I mean, even, if somebody wanted to actually start a hedge fund, besides having their own track record, they would have to go through all of the establishing the entities, filing all of the regulatory requirements, et cetera. And if you were to go to an attorney that specializes in this, and you're like, hey, I want to start a hedge fund, you'd be like, okay, I need $50,000, and I'm going to draw up all the paperwork and make sure that everything is squared away, and you'll be good to go, right? But having been in the industry myself and having actually managed private capital, there's a lot of pieces that go in the background in terms of the regulatory requirements and the filing requirements, both at the state and the federal level, depending upon the level of assets that you're actually managing. So there's a lot of pieces that go into it from the administrative standpoint that isn't really the sexy, exciting part of the business, right? But it's a necessary part of the business. And so we're going to be taking students through that aspect as well. What is the business piece of having and managing and running a hedge fund? Exciting.
I'm looking forward to sitting in on it one of these days. I mean, it sounds like a lot of fun. It's interesting. A lot of people here are like, well, I'm pretty content with my own individual way of trading, and that may be perfectly fine. But for some other ones, I know this is a passion thing for you, and you love this type of stuff. So congrats. I'm looking forward to seeing. I know that you just rolled it out. Seems a lot more complex in the crypto program than I'm rolling out. So that's.
There's a lot of pieces there, and some of the things that Scott brought up, I'm like, dude, you're gonna have to explain that to me because I have no idea what you're talking about.
Right,
He's like, oh, you know the stuff. I'm just speaking in mathematic lingo, and it's like, okay. So I'm really excited because it's I don't know, it's a way for people that are interested to get a glimpse behind the curtain and really kind of be a part of that industry without having gone to Harvard or Yale or University of Chicago or Wharton or any of the other top 10 schools that hedge funds typically recruit from.
Right. Naum asked, how many hours is the class? Is it 5 day? I think I saw 5 day.
So, not to scare anyone, but this is going to be very different than a typical class. Like a typical class, you go through the 5 days and you have your XLT support, which we're going to be doing. But there's ongoing meetings. It's not as if though at the end of the 5 days you're going to be able to go out and just set up and run your fund and congratulations, off you go.
Right.
This is a program that's probably going to be lasting upwards of about 18 months before we rotate in the next group to have them part of the fund.
Wow.
So.
Damn.
Yeah, it's a serious program.
Hedge fund's no joke. I mean,
No.
it's a lot of work. I look at what we talked about. Corey Lane on the program many times talking about his hedge fund, and have other guests talking about their hedge funds. I mean, it's not like an easy thing. It's not like just flick a switch and it's like go to the store and grab yourself some dinner. It's a little bit more complicated.
Yep. There's more to it.
All right, let's dive into our Beck report
Sure.
and give me your updates and what you think. I think we'll start things off with the bond markets. If you want, I can drive over here unless you want to share your screen, but I can drive if you just let me know what to look at. But the bond market's been an interesting one. What's your take?
It's dead.
It's dead. I mean,
I'm sure Bill Addis wouldn't say that, but when actually, if you don't mind, I'll go ahead and just share my chart here.
Yeah.
The sharing is not turned on. So
I'll turn it on. Hold on. It's me. I'm slacking over here. Right. I'm slacking. Sorry, folks. That was me. There we go. Scott, I'll bring a screen up in just a second for you. So you should be able to share now, Scott.
Okay. Let's see here. So when it comes to the bond market, hold on.
Yeah,
there we go.
I don't see it yet.
Right screen. I just wanted to make sure I had the right screen there.
Yeah, your OnlyFans page is not going to work on today's show, but
no.
Okay, there we go.
That would be a sick fetish. I'm just saying. All right, so here, this is a monthly chart of bonds, and I think it's important here for those that don't regularly view the monthly market overview with me. What I do every month is go through the process of looking at bonds, equities, commodities, and currencies, specifically bonds, equities, and commodities from an asset class rotation standpoint to determine approximately where it is that we might be in the longer term market cycle. And there's generally a very the typical rotation that takes place. And so when we're taking a look at bonds, like the big piece here, and I think I've talked about this before, but the big piece here is that when this downward move started back in 2020, this actually ended up terminating the bull market that we had in bonds since the 80s, right? So back here in April of 2022, it's like, all right, party's over.
Yeah.
That's a party that had been going on for like 40 years. And people just, drunk off of lower interest rates. And here we are now where we've had the continuation. And you'll notice that like back in October of 2023, like 2 years ago now, we came down to this area demand, tested that, we bounced up. But instead of actually reversing the trend here, it's just been inside of this mega range, right? So there's a couple of key levels that I'm really watching here. And this is the continuous contract of the 30-year bond. But we got 127.22 to 134.14. So until we really get out of this, we're just kind of stuck in this range. And you'll notice that since April, or excuse me, not April, but December, April had this really wild kind of move. We actually started to trade above that 120.18 area, but we ended up closing.
We didn't
back
close
inside
it,
of
yeah.
Yeah, but like right here, December 2024, we created this range, and we've been in it ever since. And what was interesting is that, from about May, if you were to look at like the daily charts here for the 30-year, since this period in time in May, it looks like a pretty consistent uptrend. But as we just stated, we're inside of this bigger picture range, which we ended up coming up to. So what I'm really kind of curious about at this point is, which way do we go? It's kind of like that old cartoon, which way did it go?
Yeah.
But if we end up closing back down below like this 115.24 level on like a weekly or monthly basis, I would actually expect that we're coming back down around that 110.19 area, which would mean that not only bond prices going down, but interest rates on the 30-year are going back up.
Right.
And then, of course, on the upside here, yeah, it would be cool to see a breakout above that 119.19. But by the same token, you still have to get through these levels that we saw back in December of 24 and even April of this year. Because you can see we pretty much had a false breakout
Yep.
here. We wicked out above that area and then gapped up and then came right back down a day later. So in the bond market, there are some areas where there's probably some opportunities, but in terms of market direction, when I see this, it's dead.
Yeah.
And the reason why is because look at the size of the range, right? So during this period from February through October 2023, you had this really kind of wide range. And then during this period here from October 2023 until about September 2024, so almost a year later, that range narrowed. You weren't even able to get back up to that prior high, right? And then of course, we've been in this small range basically for the last year.
Yeah.
And so every morning in the GPS sessions or every other morning, I'm just like, come on, let's go. Let's get out of this freaking range. And it's actually, I don't want to say that it's made the Beck report a little bit more challenging, but everybody keeps asking. It's like, hey, have we moved out of stage 4 yet? Are we in stage 5 yet? No. It's like basically, so long as you're in between this, nothing has changed, right? We get down below that 107.42 or 430 seconds area, then we're probably moving into stage 6. In which case, it's like, look out below, and not just for bonds, but for equities as well. Whereas if we get back above this, 127.22 30 seconds to 134.14 30 seconds, we might actually be moving into stage 1. In which case, from a cyclical standpoint, and I say a cyclical standpoint, I'm talking about like the longer term market cycle, we could be entering into stage 1, which would still be reflective of a fairly negative equity environment at that point. But stage 2 is generally where we start to see longer term market bottoms develop. So in that situation, it'd be kind of close to the end, if you will. But in order to get to stage 1, you have to go through stage 5 and 6 and stage 6. I just don't know how that's going to develop at this point. So just watching those key levels there to really stay on top of things when it comes to the bond market.
Yeah, let me ask you, Scott, and looking at that chart again, because I like where you have it drawn out there. You've got kind of this floor and this ceiling, and obviously it's a wide range, which there's plenty of opportunity in that. And I'm curious, as someone who's got a CMT and looked at just charts up the wazoo, you're probably one of the few people that's looked at more charts than I have, and I've got to be in the millions of charts over my trading career. When I look at this, Yeah, I agree with you. It's really since 2023, it's done squat, just garbage, hasn't done anything. Yes, there's swings, but when I look at this, I look at what's happened from, let's just say, June of 2025, maybe even May, that low point there at the bottom of your range, right? And you can see that we're starting to make higher highs and higher lows. So, while it's not out of the range yet, at least the way I'm perceiving it, and I'm not sure how you look at it, but I'm looking at this from a sense of optimism. Like, okay, the macro trend is still kind of sideways, but the micro trend feels like it's building some strength, which would lead me to believe that if that trend is in fact intact, that we're going to see it challenge that 120 mark or 127 at some point here soon. So is that something that you look at, kind of the micro trends within the bigger picture that you're looking at to see if there's strength or weakness, which could change your opinion?
I do, and the funny thing is this. I'm gonna share this other chart with you. Sure. It's kind of become a joke within the mastermind community because I always use it as a reference point. You know how like when you go to the airport or the malls and there's maps and you're trying to figure out where you are, and you always look for that spot and it says you are here. Yeah. I use this chart as a reference. Now, for all of those that are like, that's an Elliott wave chart. Yeah, no, you're right, it is. But I don't use it from the perspective of wave counting per se. Yeah, right. What I do is use this to help illustrate the multiple time frame relationship. So, for instance, like up here, you'd really have to consider this to be representative of the higher time frame, and then here you have the intermediate time frame, and then of course the lower time frames. So whenever I do the Beck report, I'm always starting off with a monthly chart for the very reason I'm about to explain, and that is, it is possible to have uptrends in bear markets, right?
Yep.
And when we take a look at the monthly chart, we're in something like this, right? My concern is that decline from the prior highs to those lows there in October 23 means that we're here. And if we're here, let's imagine for a moment that the lows from 2023 to where we are right now is this.
Yeah, look, it's just a corrective phase in a bigger downtrend.
Exactly.
Yeah.
And so if that uptrend terminates, then that's that stage 6. Bonds continue the bear market that they started back in 2020, and equities are most likely also in a bear market at that point. Now, but going back to your statement, right? It's optimistic. We take a look at that, but we have to more or less cross that line in the sand on those intermediate time frames to say, yeah, even though the lower time frame trend is up, we still have to take out those intermediate swing highs out there on the monthly and the weekly charts, close above those to indicate that we have gone through this cycle and now we're starting that longer term uptrend again.
Right.
So that's kind of where my head is with that in regard to the bond market, because it's and this is why I tell students all the time, just go out to a monthly chart, see the 30,000, 40,000 foot perspective. Because yeah, in the short term, right, you can definitely be bullish on bonds in the short term, right? And I say short term, I mean, that's been since May. And
right,
you might look at that and be like, dude, it's been 6 months. That's not short term. Well, in the scope of a long-term economic cycle and market cycle, it's very short term.
Very short, right?
Because generally, if you were to go to the National Bureau of Economic Research, which I refer to all the time in the monthly market overviews, they talk about the average economic expansion and contraction and the amount of time that it takes to go from one economic trough to the next, and that's just over 5 years. So when you look at the scope of 6 months within the span of 5 years, it's a long period in time, but it's not really representative of what's happening in the big part in the big picture. Yeah. And the thing that really bothers me again is this, right? And this unfortunately, this only goes back to 1998. So if you bear with me here one moment, I think I have a chart that I put together a long time ago, and maybe it's this one here. Let's see. Talking about being a geek with the charts here. But okay, so this is probably a better representation. Now, for those in your audience that aren't familiar with the bond market, what you have to be mindful of is that in the bond market, as bond prices go up, interest rates are going down. and vice versa, right? Now, with that, you'll notice that I have the same ticker symbol here, and what that is the yield for the 30-year bond. And the reason why I'm using that as opposed to, let's say, a futures chart is because the futures charts only go back to like 1998, whereas the interest rates here are going back to 1977. So I have a much longer term reference point. And what I did here is I inverted the interest rates on the price scale to represent the bond price so that you can see that inverse image between the two. But going back to what I said a moment ago, if we were to take a look at the trend here, and you'll notice I just switched to a logarithmic scale, but initially you have this long-term uptrend there in bond prices.
Yeah.
And you'll notice that I just connected like the first two lows, but notice the reactions that you got to that back in May of 2010, 2011, again here in 2018, and having again closed below that in the second quarter of 2022. To me, that says party over,
Yeah.
right? And so with the termination of that long-term uptrend, if we are in a downtrend, what I would expect is that, and you know this, right? It's like just classic technical analysis. If you see a market that's in a range, kind of like what we have in bonds right now, it helps one to look back to see, okay, what was the prior trend, right? Because the probabilities are in favor of actually going in the direction of the prior trend, which is why, looking at, for instance, that 5.19% level would indicate that we are seeing a continuation of the downtrend in bonds. And again, interest rates would be getting higher, and vice versa, looking at the higher end of those ranges here, 3.95 and 3.36%, we get through those levels, then interest rates are going down, bond prices are going back up.
Yeah. I mean, and from that perspective, though, if that long-term trend that you have going all the way back to the 1980s is in fact broken, and it ushers in that downtrend phase, right? Nobody knows exactly how long that downtrend phase does, or it lasts, but does that concern you that we might see this thing get to, all of a sudden we're looking at 9% yields on these treasury, which of course would be wild to have a 9% yield, at least for those of us who have not been who look in the markets in the 80s, but right. I started back in the late 90s or mid 90s with my trading career, and to have a 9% would just be jaw dropping. And it's not that far off. I mean, going all the way back into 87, we were at 9%. And when you think about how impactful the bond markets are, clearly the trend is broken here. And it looks like, honestly, if you look at the shaded area, it kind of feels like a descending triangle, which is one of my favorite patterns. That does usher in the probability of more increased yields for the 30-year, which of course would be an economic handicap, right?
That would be a huge economic handicap, because again, we have these 30-year mortgages, and now there's rumblings about the 50-year, and it's like, oh my God, how expensive is it going to be to finance housing?
Right, which is already expensive.
It's already expensive, So imagine doubling your interest rate. It's like, good Lord. It's just.
Don't worry, Scott. Don't worry. We have 50-year bonds coming. It'll all be okay.
I'll be dead in 50 years. So. But when you're okay, so there's a couple of different types of bull and bear markets, right? So you have what are typically referred to as secular and cyclical. And cyclical bull markets and bear markets, they can last anywhere between like a year to 3 years, right? And then you have the secular bull and bear markets. Those typically last like 18 years plus, right? And the fact that we have been in this bull market since 81, let's say, since that very low here, going up through 22, so it's 41 years. We literally have generations of people that have absolutely no idea how expensive things from a financing perspective used to be. And when you look at the degree of debt that we have, at the federal level, you look at the degree of debt that we have at the personal level, this is going to be challenging. It could put a serious squeeze on banks due to a lack of demand and credit, right? Not only for real estate and cars, but also credit cards.
Yeah.
It's like, who in the hell is going to want to pay 40%? So unless Congress steps in and caps the interest rates, which, they're not going to do underneath the current administration, people are going to be at the mercy of these banks and the rates that they want to charge just to try and finance to go buy their groceries. I mean, it's like
No, just the smart ones will do what they should do, which is cut back on their spending, right, and live within their means.
you would think, but even doing that, we can kind of go down the rabbit hole there in terms of cost of living. It's like
Right.
I could be doing everything that I possibly can to live within my means, but the cost of living is so high that it's virtually impossible. So in order for me to survive, I have to take on debt,
Yeah.
right? And that to me is the scary part, because eventually somebody's going to be like, you know what, screw this, it's not worth it, and that's where you start to run the risk of depressions. So.
Well,
And
especially if there's a run on the banks, because we know our fractional reserve banking system is fragile at best.
yeah, I haven't looked at the requirements lately on banks, but if I
There's not
remember,
much.
There was headlines that actually reduced it not too long ago. It's
Yeah.
like, okay, cool, they want another 2008 again. That's awesome.
It's wild. It's wild. And looking at that chart, obviously this is the long-term end of the yield curve, which, that's going to be kind of free market demand and supply driven. The short end of the yield curve, we've seen this one. It's certainly much higher than it should be, and of course we've got certain members of the Federal Reserve who wants it much, much, much lower. I don't know if you saw the most recent Fed funds futures. I know you probably can't see my screen here, but this is the CME group. I wanted to bring this up because as of just a few days ago, this was like a 65% probability of rates being cut. Now it's only a 33% chance they're going to have a rate cut. It was 97% chance of a 25 basis point cut in October, and now we're only at 33%, with the majority saying that we're going to stay right where we're at. Based off your scenario, which looks like, and again, you don't know the future, it's just based off the technicals and fundamental stuff. Based off the chart you were showing, it looks like that 30-year bond has a higher probability of increasing in yield, which would be a little bit of a drain on the market depending on how much it rallied. The short end, right? This is the piece that I think is probably the most concerning one at this point from a bond perspective or a treasury perspective, because this is your short-term lending rates, your overnight rates. And if these continue to fall, that stimulates the economy. Great. That's kind of what people want, right? That's what Trump wants. That's what Bessent wants. Let's lower those rates. But if we do that, then we run the risk of significantly increasing inflation, which is not at the 2% target that the Fed wanted. And I'm curious to get your take on our current cutting environment. Should they cut? Do you think that they're doing the right thing? Or is it just wild to be cutting when interest rates or inflation is still at 2.9%?
Well, it's hard for me to answer that question without having been able to look at the data for the last month and a half due to the government shutdown that we've
You're one of the data guys. Data dependent over here.
So thanks for putting me on the spot there. But this is just anecdotal. Thank you. Anecdotal evidence. I don't know. I've forgotten how to speak in the past week. So anecdotally. There you go. What I would state is that when we look around, I don't think anybody is celebrating higher prices at this point. Nobody is like, oh my God, it's like I went out to the grocery store last week and beef was $25 a pound and now it's 12 and a half. It's party time. No, it's not. So I think the Fed right now is actually in a real kind of bind here because they're fighting the possibility of a slowing economy and still seeing inflation. And so until we actually get that inflation under control, they're going to have to hold pat on the interest rates to try and keep inflation under control, So, and granted, back in 2009, they came up with the whole quantitative easing thing. So who knows what else they can come up with to try and fight inflation. But it's not out of the realm of possibility here that we actually enter into that stagflation environment or something even worse. They were talking about like a K economy where there's those that are I wouldn't even say upper middle class, but above upper middle class that are it's like what's everybody's problem, but everybody else below that level is like, dude, we got a serious problem here. So. I think the Fed's going to be in a bit of a bind. So keeping a close eye on the yield curve obviously is important. I think from a strategic standpoint, the way that I've always looked at it is that if the Fed is in a loosening mode, it's better to just go out to the longer term and try to lock in that yield, right? Whereas if they're tightening, then I'll try to err on the side of the short term because as those rates go up, I'm going to be able to roll my bonds over into the next maturity and try to lock in that new short-term interest rate until at one point in time they stop raising the interest rates, and then again I'm going to move out to my longer maturities, the 10 years, 30 years, et cetera. So so right now I think flexibility is going to be pretty important because they're cutting interest rates, but not by a large degree.
Yeah.
So in terms of maturities, sticking between that 5 to 10 year is where I think a lot of people would probably be. But if they engage again in the reduction in the interest rates, signaling that the economy is probably slowing down, then we're probably going to see a little bit more demand down on the shorter end of the curve than the longer end.
All right, I got to move on from bonds because we're already 35 after, and we could go on this for an hour. There was a question on how would you trade this. So, for example, someone said TLT. Look, remember, if yields are going to go up, if you expect that 30-year to go from 4% to 6% to 10%, you're shorting TLT. You would not be buying. It's the opposite direction. So, if you felt that yields are going to go down, you would buy TLT, and that's the conundrum that we're in. Obviously, we have a Federal Reserve, we have a president and a secretary of the Treasury that all want lower interest rates and want those yields to drop, but they can't single-handedly control the long end. The short end, they can certainly manipulate more, and that's going to be a wild scene going forward. Now, based off what you talked about, the equity markets have been a very interesting one. We've been talking a lot about, at least I have, I think I might be overly opinionated here on the impact of the Magnificent Seven stocks, particularly AI, NVIDIA, OpenAI's reckless, spending of money they don't have, and kind of inflating what appears to be somewhat bubblicious to me. Curious to get your take on, let's just do the S&P from an analysis perspective. What are you seeing there with the S&P in this recent sell-off?
Sure, I'll go ahead and put this up here for you guys, but so this is the long-term monthly chart here for the S&P 500, and there's a couple of things that I want to point out here.
Look at all that scribble. You put a lot of stuff on your charts that I can't even see what price is on the last quarter, last 5 years.
This is the Picasso of charts.
It'll be in the Louvre someday. Hopefully they don't steal it.
Yeah, but again, what's the purpose of the Beck report? I'm not trying to day trade off of this information.
True. I just love giving you a hard time.
Where the tide is. Oh no, I know. Trust me though. There's students that joke about this. It's like, oh, here comes the Scott chart, But when we take a look at 2009, right? So actually going back into 2013, that was the end of the secular bear market. So this yellow shaded area was the secular bear market. We come back here into 68 through 80. That was the secular bear market, and then of course we had the secular bull market from 80 going up to 2000. And from where we are here in 2013 to where we are today is a secular bull market. So that's really kind of being defined here by this long-term blue trend line, right? And then after the lows there in 2020, we actually saw an acceleration to the upside. And I think that really kind of goes towards what you were just describing, which, we have the likes of NVIDIA. That is an extremely high market cap weighted stock within the S&P, within the not just the NASDAQ, but the XOK, which is the biggest sector within the S&P 500 right now. And we were talking about this over the weekend in terms of trying to understand the importance of how these indexes are weighted, their components, and the impact that they can actually have on the broader market. Because if we did start to see like any types of cracks emerge within that particular industry, because it has been so influential, we could actually see, another crash, for instance, like we had in the NASDAQ back in 2000, right? I mean, the drivers are different, but the theme isn't necessarily completely different. I'm not sure if I'm saying that exactly correctly, but when we take a look at where we are here, we're certainly in an impulsive phase within the overall, broader bull markets. Here we have that 2022 low. So obviously we're in a cyclical bull market within the context of a secular bull market. That 2021 through 2022 period was that cyclical bear market that I was referring to earlier. But you'll notice here that we had a forecasted high that we reached back in January, December of last year. January of this year, we came up to the next measurement there at 1.127, kind of based around a little bit. Solid continuation here at 1.272, seeing a little bit of a slowdown. So if we manage to continue this, my next targets are around 7,200 to 7,700 on the S&P. The key level that I'm watching here down on the weekly chart is coming in and around this 66, that 65, 50, 78 level. Now I'm using the cash index. I don't use the SPY or the S&P futures for long-term market analysis. They simply lack the historical data. But we've been in this impulsive phase basically since April. And when you're taking a look at the degree of sell-off that we had here in that February-April timeframe, so just within the span of that week and a half or so, the markets were down 21%. So even if we were to look at where we are here right now, a 21% decline from the high that was put in back on October 27th would put the market down around approximately that 54.47 level, right? That would actually bring us back down here to this area where we saw the market really kind of terminate that move. So, is that out of the realm of the possibility to do that? No, happened before. It can happen again. In 20%, usually that's the medius threshold there for a bear market.
Right.
I mean, I wouldn't call this a bear market per se, but because we had we didn't see the termination of the longer term trends. So
right.
Here, that's just basically what I'm looking at in the short term. Now, obviously, with NVIDIA coming out today, I don't think that we're necessarily going to get above the swing high from a few days ago right away, but maybe it's going to be enough to support the market here above that 65.50 level and actually see the continuation above that 69.20. And if we do, that's when I'm looking for that 7,200, 7,700 level in the S&P.
Nice.
One of the other primary concerns that I have here is that of the Russell, actually, because I was making this really, really bad joke yesterday, but anybody familiar with Caesar from Shakespeare, the line is beware the Ides of March, right? Well, here for the Russell, it's beware November, because back in November of 2021, we saw this top. Here in November 2024, market rallied up, failed to break above that high, and then December going in through April of this year, we obviously saw a pretty big sell-off. And then last month, I got pretty excited. I'm like, all right, cool, we're breaking out here, but no, we're not. We're right back inside of the range again. Right, exactly. So, if you're making relatively equal highs, there's that chance of making relatively equal lows. Now, this one here, it actually managed to stay north of that 1,700 level, which, it's kind of a bullish sign back in April, but failure to get above that area, you add into it the possibility of breaking below that 65.50 level on the S&P, and I wouldn't be surprised to see us come back down to around at least that 2029, possibly even that 1,700 area inside of the Russell. And this is going to be a little bit more representative of, I think, the broader economy, because the Russell follows your small and mid cap stocks, and I think this is going back to that comment a moment ago about the K economy. Well, here, the Russell's been flat for the last 4 years, whereas the S&P continues to move higher. So those large cap stocks are really experiencing a lot of benefit to the upside there, whereas the Russell's trying, but they're just not able to make it. So, this breaks, everything else is going to get pretty bad here.
Yeah, and it looks like that Russell's been rolling over. I mean, if you go to the daily, we dropped down below some kind of key levels there. So that, there's always that canary in the coal mine perspective, which I do subscribe to. I do believe that the Russell is a leading indicator for the equity markets. But remember, the Russell doesn't have NVIDIA. The Russell doesn't have a Microsoft or a Google or a Tesla in it, so which have been driving this S&P up. I mean, that's a majority of the gains of S&P have been those, 4 companies.
Yep, that's exactly right. And I think that that's really important for your audience to really recognize here, because when you look at just the index itself, you're looking at the market, with blinders on, basically. Like one of the things here that we always do as part of the Beck report is we look at the relative strength here for each of the sectors, and I'll share something that is a little sobering here in terms of the state of the current bull market. But if we go through and look at the sector relative strength for every single one of the sectors within the S&P 500, and it'll take me 2 seconds here once I get all these charts open. But this is consumer discretionary, right? This is breaking down. That's not good. This is technology. Even though we had the continuation here, we're showing a little bit of weakness over the course of the past month or so. Here, this is communication services. This broke down below the prior controlling swing low there from July, so that is not looking all that good. Industrials have broken down outside of this channel. Energy continues to be weak. Here, materials continues to be weak. So all of these, these two in particular, are showing that those sectors have underperformed the S&P 500. Now, this is the smallest sector. It's like 1.9% of the S&P 500 right now. So it's almost like, who cares?
Right.
But then when you take a look at technology, that's 36% of the S&P, right?
Yep.
If that breaks down, especially getting below the swing low from back in September, yeah, you're coming back inside of that bigger picture range, and we're probably going to see some pain. You take a look at the consumer staples. This is probably one of the bright spots in the sector rotation relative strength analysis, because if we were moving into a bear market, you would probably see that this is rotating higher, and we haven't seen that. What we've actually seen so far is a continuation of the trend. So at least on the institutional level, we're not seeing institutional money kind of rotate into this otherwise traditionally defensive sector. And then here you've got healthcare, which has actually seen a little bit of a bottom here of late, but the longer term trend is still down, basically since 2022. Utilities here, this, it was kind of interesting because this past year we've seen a lot of strength in a lot of different utility stocks, which is out of the ordinary, but a lot of that comes from the data centers and the AI and just that whole theme. But here we've actually seen a bit of a slowdown over the course of the last 6 months. Here, this is finance, and this is the one that really concerns me the most. Because when we take a look at finance here, you can see that going back into the second quarter this year, we actually terminated the longer term trend that had been up since the summer of the last year. And we've seen a continued deterioration in the relative strength versus the S&P 500. And the reason why that is so concerning is because when you take a look at the S&P 500 and its components, not its constituents, so not its individual stocks, but when you look at the sector at the sector level, finance represents the second most heavily weighted sector within the S&P 500. So that's not going to support things very well. Consumer discretionary is the third most heavily weighted. Communication services is the fourth. So what we have here right now is the second, third, and fourth sectors within the S&P 500 are already showing weakness. Information technology, which is the top, is showing at least some short-term weakness. The longer-term strength is still in play, but that breaks. That's just going to add, a large weight on everything else.
Yeah.
So when you look at this frightens me, right? Because when you add these up, you're talking close to almost 80% of the S&P 500 is controlled by the top 5 sectors out of the 11.
Yeah.
So even if these really defensive areas like staples, utilities, real estate, they turn around and they actually do well, they would have to go up like tenfold in order to offset the decline in the other sectors.
Yeah.
So it's crazy.
There was a comment here. Liz, isn't XLY largely Tesla? It's 20% Tesla. It's actually 23% Amazon if you want to break down the top components of XLY.
Yeah. So pardon the pun, but yes, XLY is driven by Tesla.
But
yeah, you're welcome. But it's not the only component, right? So it is important, just like I'm breaking down the sectors for the S&P 500, you can continue to go through the same process for each one of these ETFs to see, because all of these are market cap weighted indexes. So whatever the biggest components are in terms of market capitalization, that's what's driving it. And Tesla is certainly going to be in the top 10 for the XLY. So it's, you have to roll up your sleeves, do your homework, and see where the strength and the weakness is. Because again, the cracks will appear in these types of charts before you actually see it in the price chart. Because you go back and you look at the S&P and you're like, what's the problem?
Still looks good.
Yeah, we're in a bull market. It looks all right, but it's just not. That's like looking at a bull market after somebody ran a marathon and be like, hey, you've got another 26.2 miles to go. They're just going to look at you and be like, what? No. It's like, maybe they can do it, but you're going to have like an EMS crew riding along with them,
Scott, I don't want to keep you long, but we've got a couple. Any quick comments on the commodity side of things? I mean, I'm loving commodities right now because I've watched orange juice and cocoa and cattle and cotton and sugar and lean hogs all plummet recently, which I'm loving because I'm getting near, it's turkey time, it's prime rib season, and I want the cattle to fall in prices. But
Right.
anything on the commodity front worth sharing with our audience, or the currency side, so we don't go. I'm trying not to do a 1 hour show today. That's the problem.
No, you're fine. As a matter of fact, on the commodity side of things, last month so I'm switching things up a little bit. When I do the monthly market overview, I had been just kind of doing like the whole thing and kind of doing a really high level view of commodities in particular. But last month, the end of October, we looked at the commodity side a little bit more closely. And then this month, next Wednesday, we're going to be looking at the currency side a little bit more closely. But and these are just some really basic charts here, just looking at the continuous contracts. But when you look at the energy market, oil right now is just dead. You look at nat gas. Nat gas is actually starting to show a little bit of strength here. Heating oil also indicating that it's attempting to break out. What is that? The RBOB there showing a little bit of weakness. But going into the grain side of things, right? And notice again, I'm on a monthly continuous chart for each of these. Not a whole lot happening here with corn. Soybeans there breaking out, which is kind of interesting, because this is really kind of reflective of sell the rumor, buy the news. Back during this period in time, a couple of months ago, all you were really seeing were the headlines about how the soybean farmers are losing out because China's not buying all of their soybeans, and then all of a sudden, we see soybeans actually breaking out of a range that they've been in basically since August of 2024. Here you've got live cattle, right? Live cattle, as you pointed out.
I'll take the pullback. I know it's been going up since 2019, but I'll take a pullback for goodness sake. Go lower.
Exactly. I mean, it's like you can. It's amazing how you can participate that and actually hedge your big celebratory rib roasts. But here. You've got sugar.
How sweet it is.
Continuing to trade lower there. Cotton here just kind of trading in a range. Cocoa also, Nestle is not hedging at this point. Here you've got coffee just trading in a range. Wheat also not a whole lot happening here. Hogs getting cheaper, so I'm looking forward to doing some pulled pork again soon.
And I don't even drink orange juice, but this chart is ridiculous. Like this is incredible.
Right. Turn those machines back on.
Yeah,
Get those workers back in here.
I wrote an article. I think it was 2023 or 2022, and it said, "Say goodbye to bottomless mimosas," because the chart of orange juice was parabolic, and I'm like, this is it's done. And now all of a sudden it's right back down to those lows. It doesn't make any sense. It's wild.
No. So gold here, obviously the rock star this year. That's crazy. And silver, same thing. Getting down here into copper. Also it's so copper here actually breaking out, but you saw it kind of pull back into a range. This had a lot to do with the tariff announcements back in July that Trump made. I think he said there's going to be like a 50% tariff on copper, and then like a week later he came out and said no, there's not. So that's probably still figuring out what it wants to do. And then of course aluminum here. Which I used to chart aluminum a long time ago, but they took it off of the U.S. exchanges, so you had to use the LME, the London Metal Exchange, for information. But this is a pretty heavily used industrial metal, and you can see it's actually breaking out here over the course of the past couple of years. So it's going to be interesting to see what happens because, from an industrial standpoint, to an extent, would it be nice to have like a more diversified economy other than just a service-based economy? Yeah, a little bit. But I say a little bit because you don't want to be breathing smog and stuff like that. But as it stands, the real thing that pops out here to me is gold. Just that is an incredible bull market and has been basically since the lows there in 2015. And if we take a look at how far that last bull move went from 2001 to those highs there, I believe that was back in like 2011. Check this out. This is crazy. So that was a 656% move. We just take that and do one of these. Another 665 or 656% move would put gold at 7,800.
Not impossible. I mean,
Sweet baby Jane. No,
yeah.
not impossible at all. You go back here to 76, right? Take a look at this. All right, this is crazy. That was a 772% move. So, the 70s, they're like, what's your problem? So who knows? Maybe the gold market's gonna be like, hey, hold my beer, because if it does what it did before, we could see gold get up to what is that? Let's delete that there. That would be 8,900. Let's just call it 9,000.
And I think you would agree that, we don't know whether it's going to be this year, next year, but at some point, I'll go out on a limb and guarantee at some point gold will be 7,800 or 7,900 bucks an ounce. I mean, it's just a supply and demand.
Yeah.
And time.
I mean, here, let's, price and time here, right? So how long did that last? Apparently I turned off that data.
You did turn it off.
A different way here. So, this bull move here basically lasted 148 bars. So that is
12 years.
Monthly chart. So, yeah,
12-year run.
So if we had another 12-year run, that would put it out to 2028.
That seems reasonable. I'm in. Stay long. I got my gold coins. I'm ready for it.
Yep.
I want to quickly just show everyone where you can find out, because I was going to ask Scott where he's teaching, where you guys can find him. If you go to my OTA, if you guys are OTA students, and you click and look at the calendar and type in McCormick, you'll see his calendar, and it's pretty full. He's got a lot of stuff going on. Here we are the 19th, so he did a GPS mastermind session today. He'll do a GPS session on Friday as well, and you can see his upcoming sessions. He's got a general session for those of you that have limited access. That'll be next week on the 26th, day before Gobble Gobble Day. You got big plans for Thanksgiving, Scott?
I'm going to Michigan. I'm
Michigan.
going to visit my mom, who recently moved back home. And I say back home, back to Michigan, where my mom's side of the family is from Michigan. And so I'll be spending about a week and a half up there and enjoying the cooler weather. I came back from Scottsdale on Monday night. And, of course, you have this association with Phoenix and heat, right? So yeah. I'm like, we're going to go to Scottsdale. It's going to be like super nice and warm. No, it was nice. It was beautiful. It was actually cooler there than it was at home. When I came home and was out and about yesterday, it was 87 degrees.
I know.
It's November.
I'm not looking forward to the heat, but
60, 55 maybe.
I'll enjoy it when I get there. I'll probably be by the pool a couple times, but should be good. Yeah. All right. Well, hey, thank you very much, Scott. I appreciate you coming on, taking your time. And if you, we'll probably get you on at the beginning of the year. We don't have you on too often, but we'll get you on for a year outlook, and then we'll review how close you and I and other instructors and actually audience came with our forecast for 2025, which some of us are way off. That's for darn sure. But I appreciate you coming on today. Thank you very much.
Yeah, it's my pleasure. Thanks for having me. Enjoy your time here in Dallas. If you get a chance, go to Hutchins Barbecue. It's going to be right up the road from where you're going to be, and they have some of the best barbecue here in Dallas. So check it out. Written down. I'm going. I'll send you pictures from it. All right, buddy. Thank you very much. I appreciate it. Have a happy holiday. If I don't talk to you before then, and safe travels, my friend. Thank you too. I take it, guys. Scott McCormick. What a wealth of information. Too much. I mean, it's almost overwhelming how smart this guy is and just the things he looks at as you guys are watching it. I'm over here controlling things and trying to learn along the way as well. Just tons. And I apologize I didn't get to so many questions. Scott likes to talk, and he goes down these rabbit holes. I didn't want to interrupt him too much, so I was apologize, Chad. I know you sent a whole bunch of questions in, and I wanted to get to all those, but yeah, I didn't get a chance to get to them. My apologies. Let's see, real quick, let's just talk about NVIDIA, just so I can wrap this up. And unfortunately, or actually fortunately, you guys are going to get a 1-hour show today. Seems to be the way it's going to work. So here's NVIDIA, giving back a little bit of their gains after hours, but I will put on a 5-minute time frame here so you guys can see the pop. Everything in yellow, obviously, is the after-hours session, and I'll read through some of the numbers here. NVIDIA's revenues jumped to $57 billion. That is 62% year-over-year growth. Their earnings per share jumped to $1.30. That is a 60% year-over-year. 60% year-over-year growth for revenues and earnings per share is phenomenal, right? Especially for a company that's got a degree of maturity to it. Like even a small cap company, you get a 60% run, and you're like, this is fantastic. Now, you look at their data center revenue, that was up 66%. Their Q4 revenue guidance is up to $63.7 billion. That is increasing
estimates, and that was one of the reasons they popped here. Their gross margins is the one that just is jaw-dropping here. 73.4% gross margins. That's a huge number. Now, I do think that number will start to get chopped down a little bit, right, with competition as it comes in, but still, no one's competing with them. And it's not just that they got the chips, but they have the infrastructure to support all the services that their clients want and need, which really gives them a tremendous advantage. So congratulations to NVIDIA, and thank you, NVIDIA, because you completely saved my ass on my trades for this week. We'll see how it ends up by Friday. But I've got those Amazon puts, and I've got the CoreWeave puts as well. We'll see. Actually, no, I'm long CoreWeave, and I got the CoreWeave calls at 82. I may actually get taken out of CoreWeave. Let's see what it's doing right now. CRWV. Okay, 79. I have the $82 strikes. Be perfect if we end on Friday at $81. It'd be amazing, and then I'll just sell the 85s, and then all of a sudden it's looking good now, Big Eb. It's looking good now, but who knows how it will transition going forward. All right, that will do it for me, everybody. As I mentioned, I'm going to be off in Dallas, or off to Dallas over the next couple of days. Looking forward to that one, and hopefully come back with some nice stories, some pictures for y'all. And I'm certainly going to go to Hutchins Barbecue in Dallas, Texas, as Scott has recommended. So I hope you all enjoyed that. We got a little heavy dose of technicals and a lot of macro, big picture stuff. Take it for what it's worth. And for Oliver out there, he says, here comes the doom. That's not doom and gloom. Watching the price of cocoa and cattle and orange juice plummet is not doom and gloom. That is actually super positive, right? Because when those things fall, the cost to you and I usually gets passed on as savings. That means inflation drops. Now, those things aren't the highest recorded for inflation, but it does have a big impact. So bring it on. Let's go for lower prices. Let's see catastrophic charts on corn and wheat and soybeans. I want this one right here. The lean hogs chart is the one that I want to see absolutely crater. I want to see this one go through the floor. Here's the lean hogs chart. I want to see this tank. I don't want it the 216. I want this in the double digits. Get me down to 50 on lean hogs or on live cattle. Probably not going to happen, but there we go. Anyway, hope you guys have a fantastic time without me. If you have questions, you can email me at tradermerlin@gmail.com, and I'll be back with a full show on Monday. Have a great rest of your week, everybody. Be careful out there tomorrow. I expect more volatility because of how the markets react to NVIDIA and their earnings. Take care, everybody.